Welcome back to Your Average Investor, the channel that looks at my journey through investment, budgeting and finance. Today we're going to take a look at another one of my investments that I hold on the Vanguard platform, and that's the FTSE 100 ETF. Now this ETF is underperforming for me at the moment, with it being the only ETF I hold on the Vanguard platform which is currently netting me a negative rate of return. However, it does offer quite a nice dividend over time, so that does somewhat counteract the negative rate of return I'm seeing at the moment. This video is going to have a similar structure to my previous video on the S&P 500 ETF. So we're going to look at the ETF's holdings, we're going to look at the distributions, the fees that you expect to pay, and the historical growth of that ETF. As a UK investor, I believe it's really important to have some sort of allocation towards the United Kingdom within my portfolio. And I've decided to go for the FTSE 100 over the FTSE 250 at the moment. Now, while the FTSE 250 might offer more growth over time, the FTSE 100 is full of companies which are proven and have a good track record, and therefore they pay consistent dividends over time. And therefore I decided to go with the FTSE 100 for my own portfolio. Now, your decision might be different based on your portfolio type and your investment horizon. So this video is purely meant to break down the FTSE 100 and show you the fund in its purest form. It's not a recommendation. So without further ado, let's hop onto the Vanguard platform and check out the Vanguard FTSE 100 ETF. Here we are then on Vanguard's website. If you want more information on how to set up your initial Vanguard portfolio, why don't you check out one of my previous videos which walks you through just that. When you look through Vanguard's exchange traded funds, you'll be able to see that they're categorised by their geographical location. You've got investments in Europe, global investments, and then the ones that we're looking for today, which are investments within the United Kingdom. You can see that Vanguard offers both the FTSE 100 and the FTSE 250 in ETF form. Today we're going to be looking at the FTSE 100 ETF. From quickly eyeballing what you can see on screen, you'll be able to see that the ongoing charge for the FTSE 100 ETF is very small at just 0.09%, and it is made up of 100% equity as you would expect. Vanguard rate the risk of each of their funds on a scale of 1 to 7, and they've rated the FTSE 100 ETF as a risk rating of 6 out of 7. This is increased from 5, which it was previously. However, it's increased up to 6 now following the coronavirus pandemic. If we have a look at the main overview of the FTSE 100 ETF, you'll be able to see that the current market price of the fund is £27.05, and that's decreased by 1.39% over the last day. Within the FTSE 100, there are currently 103 stocks, and we'll take a quick look at what those are in a moment. As I've already said, the ongoing charge fee for the FTSE 100 ETF on the Vanguard platform is incredibly low, at just 0.09%. And this is one of the major strengths of the Vanguard platform. You can also invest in this fund through trading 212, and by doing this it actually works out cheaper than by investing directly through Vanguard. This is because while you'll still have to pay the ongoing charge fee for the fund, both on the Vanguard platform and on trading 212, you will not have to pay any account fees on trading 212. Comparatively, on Vanguard you would have to pay 0.15% account fee on all the holdings within the account. Whereas obviously on trading 212, it's fee-free investing, except for obviously the ongoing charge fee. If we take a look at the price and performance of Vanguard's FTSE 100 ETF, as I've already said, you'll be able to see that the market value of this fund is £27.05, with a 52-week high of £33.94 and a 52-week low of £22.31. This shows the volatility of this fund this year, and this is one of the reasons why I believe Vanguard have increased their risk rating from 5 to 6 for the fund. This is largely due to the fact the FTSE 100 is 100% equity, and there's no bond allocation within this fund to hedge against any economic slowdown. Equally, when looking at the sector allocation within the FTSE 100, the majority of the sectors that are held in large quantities within the fund were hit particularly hard through the economic slowdown, as you'll see in a moment. As we keep hearing on the news and in other media, 2020 has been an unprecedented year, so to look just at the fund in this particular year would be unfair to the long-term growth of it. Therefore, if we look at the growth of a lump sum investment in April 2012 of £10,000, you'll be able to see that that value of that fund has increased slowly over the period of time up to April 2020, where it is now valued at just under £16,000. However, if we were able to step back 6 months in time,
before coronavirus, it would be valued at over £18,000, which does show the growth this fund has seen in that time. Now we've had a look at the historical growth of this fund, let's have a look at the portfolio data and see what companies make up this fund. By having a look at this data, you'll be able to see that the region exposure is 100% to Europe, which we would expect because the FTSE 100 is a UK-based fund. Again, if we look a little further, the market allocation is obviously 100% toward the United Kingdom, which matches the benchmark 100% accurately. By looking at the weighted exposure of the FTSE 100 ETF, you'll be able to see that a large chunk of this fund is made up from both financials and consumer goods. Healthcare, consumer services, industrials and oil and gas all make up over 10% of this fund also. If we have a look at the bottom of this list, you'll be able to see that technology makes up a small 0.8% of this fund, and when compared to the S&P 500, this is tiny in comparison. This is probably one of the main reasons why the S&P 500 has seen far superior growth when compared to the FTSE 100. Over the last 5 years, technology has exploded onto the scene, with it seeing massive. Over the last 10 years, technology as an investment has absolutely exploded, and it's seen massive growth over that period of time. Because there are not that many tech-based companies within the United Kingdom, the FTSE 100 has not seen the same level of technology-driven growth. While this isn't necessarily an issue, it is important to note this when investing in this fund, and it shows the importance of fully understanding the allocations within each of the funds you invest in. Taking a look at the top 10 holdings, you'll be able to see that AstraZeneca and GSK make up around 13% of the overall FTSE 100 ETF. This is quite a large allocation towards the pharmaceutical business, and at the moment that's no bad thing. Collectively, these top 10 companies make up around 38.5% of the overall holdings of the FTSE 100 ETF. This means that the performance of these top 10 companies will have quite a large impact on the overall value of the FTSE 100 ETF. Again, this isn't necessarily a bad thing, however it is important to note this when you invest in this product. If we take a look at the dividend payout of the FTSE 100 ETF, you'll be able to see that it currently sits at around 4.23% per year. The most recent dividend payout was substantially lower than that we've come to expect from this fund, at just 10 pence per share. And as you can see on screen, previously we've come to expect around 30 pence or 40 pence per share each quarter from this fund. Now, this is obviously largely due to the coronavirus pandemic and the fact that lots of the companies within FTSE 100 have been hit particularly hard, and some of the larger companies, for example Shell, have stopped their dividend at the moment. Shell are obviously a large dividend paying company, so that's obviously affected the overall dividend that we can expect from this fund. Worryingly though, this 10 pence payout per share for the dividend this quarter sits at lower than the S&P 500 dividend this quarter. Comparatively, the S&P 500 has seen larger growth over the last 10 years than the FTSE 100 has been able to achieve, largely due to the fact that the S&P 500 includes lots of large technology companies, which have performed particularly well of late. Now, while I don't expect the S&P 500 to outperform the FTSE 100 in terms of dividends in the future, if this trend does continue as we've seen this quarter, it may make me question my allocation towards the FTSE 100 within my portfolio. The main reason I hold for FTSE 100 at the moment is because I think it's important as a UK investor to invest within the United Kingdom, and also it gives a nice dividend over time, but it can't quite replicate the growth that the S&P 500 sees. Therefore, if the S&P 500 still sees the same levels of growth and pays a greater dividend than the FTSE 100, it may make me move some of my allocation across from the FTSE 100 to the S&P 500, as this will see my investment portfolio grow greater. As I've said, I don't see this happening, and once coronavirus is gone, hopefully in the next year or so, I do see the dividend of the FTSE 100 outperforming that of the S&P 500, as we've come to expect in previous history.
So there we have it, Vanguard's FTSE 100 ETF. As you've seen, it's not grown too much over the last year or so, with it trading fairly sideways and actually netting me a negative rate of return in that time. However, it has paid a consistent dividend, albeit the last dividend wasn't up to its usual standards. As I said, last quarter's dividend was particularly low, especially when compared to the previous dividends from this fund. As I said, this is the first time Vanguard's FTSE 100 ETF has given a lesser dividend to Vanguard's S&P 500 ETF. Now, the main thing to note here is that Vanguard's S&P 500 ETF does show greater levels of growth when compared to Vanguard's FTSE 100 ETF. The real strength of Vanguard's FTSE 100 ETF is the great level of dividend that historically it's paid over time. Obviously, the lesser dividend this quarter can be attributed to the fact that coronavirus has occurred and lots of businesses haven't made the amount of cash they would normally be during the same period. Now, if this continues over time and the FTSE 100 companies don't get back to the same level of dividends that we're used to seeing them pay out, the S&P 500 could be the greater option in the future. This is because the S&P 500 shows great levels of growth and in the last quarter it paid a greater dividend. So if this continues in the future, the S&P 500 could be the better option. Now, I obviously think that the FTSE 100 companies will continue to pay their usual dividend in the future when they start to make the usual income and revenue that we've come to expect to those companies. But it will be interesting to see this over the next few quarters and to see how the FTSE 100 dividend recovers. As usual, if you've enjoyed this video or found it useful, please drop it a like and comment and subscribe to the channel as well to catch all my future portfolio updates and other investing tips. If you don't use Trading 212 and you want to, check out the link in my description below, and by signing up with just £1, you'll get the free share valued up to £100 and so will I, so it will help both of our investment portfolios grow. And also, if you want to make some extra money, check out my videos on match betting. I'll pop a link up above where I make over £600 each and every month. I'm currently doing a challenge throughout the month of July to try and make over £1,000 through match betting, and I'm doing really well at the moment. However, I'm not sure I'll reach that target. Once July is over, I'll tot up all the money that I've made and I'll deliver that back in a video to show you how much you can make through match betting in a month if you really go for it. Hopefully I'll see you there, and with that said, I'll catch you in the next one.